Happy Thursday, everybody. Welcome to another episode of China Update, where we discuss leading political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. We're going to take today off, but there is a lot to cover, a lot has happened, so let's jump in. And first up is the Chinese economy, and we have 2 updates to cover. China's fiscal engine is showing signs of fatigue, with government spending growth slowing for a second consecutive month and exposing a potential drag on an economy already under broad pressure. According to Ministry of Finance data, total expenditure under the country's 2 main fiscal accounts rose 6% in August from a year earlier, reaching 2.7 trillion yuan, $380 billion. That marked the weakest pace since May. Revenues barely grew, inching up just 0.3% to 1.6 trillion yuan, widening the broad budget deficit for the January through August period to 6.7 trillion yuan, almost $1 trillion. Economists say the slowdown reflects Beijing's reluctance to unleash aggressive fiscal stimulus despite mounting signs of economic weakness. Quote, the August slowdown in the government spending growth, continued accumulation in fiscal deposits, and the sharp decline in infrastructure investment during the July through August period suggest policymakers are not in a rush to step up stimulus. End quote. Goldman Sachs analysts led by Li Shengwang wrote in a note today. Why is Beijing so reluctant? Well, as regular viewers know, the country generally, and local governments specifically, are drowning in debt, and so much spending is seeing very little return. The calling follows front-loaded spending earlier this year too, deployed to cushion the economy against a shock of US tariffs imposed by the US president. But August also saw the first deceleration in net government bond issuance this year, constraining Beijing's ability to finance new projects. The impact has been clear. July and August have emerged as the weakest months for China's economy in 2025, with fixed asset investment slumping and heading for one of its worst annual showings on record. We discussed this earlier this week. What's worse, tax revenues have stagnated, up just 0.02% in the first 8 months to 12.1 trillion yuan, while local government land use sales, a key source of extra budgetary revenue, dropped a painful 4.7%. And this is after years of decline. While calls are growing for more support, Beijing's rising debt load is limiting its options. For now, the government seems likely to pursue incremental, targeted easing rather than a sweeping fiscal expansion. So with all this in mind, and this moves us to the second story, how is it that we have seen a blistering rally in Chinese technology shares, which accelerated on yesterday, sending the Hang Seng Technology Index to its highest level in nearly 4 years? The gauge, which tracks Hong Kong-listed heavyweights such as Alibaba Group Holdings Limited, Baidu Inc., and Semiconductor Manufacturing International Corp. SMIC, and JD.com Inc., climbed 4.2%, extending its winning streak to 7 consecutive weeks. Baidu led the surge with an impressive 16% jump. Well, it appears that this has been fueled by optimism about Chinese AI. We also note that China's stock market was so poor in recent years that this jump has come off a low base. The index has now gained 42% this year, outpacing regional peers as easing US-China tensions and renewed confidence in artificial intelligence lift sentiment. Quote, China tech leaders are visibly re-accelerating AI spend and product rollouts, while also proving they can monetize AI faster than many expected, end quote, said Charu Chanana, chief investment strategist at Saxo Markets. Despite the rebound, valuations remain cheaper than US counterparts, with the index trading at about 21 times forward earnings compared with 27 times for the Nasdaq 100. Momentum has also been underpinned by heavy AI-related investment. Bloomberg Intelligence estimates that combined capital expenditure from Alibaba, Tencent Holdings Limited, Baidu, and JD.com will more than double to $32 billion in 2025 from $13 billion in 2023. Recent funding moves reflect that spree. Alibaba raised $3.2 billion via convertible bond sale last week, while Tencent tapped the offshore yuan bond market for the first time in 4 years. Investor confidence is also supported by regulatory and geopolitical signals. SMIC shares jumped over 7% on reports of progress with domestic chipmaking equipment, while hopes for a thaw in US-China relations grew after the US President Donald Trump said he would speak to Xi Jinping this week. Still, despite all this attention on surging Chinese stocks, and this is a key point to keep in mind, the Hang Seng Technology Index still remains 70% below its February 2021 peak. So, while the market has done very well year to date, over the last 5 years since its last peak, it has still been terrible. The excitement is also concentrated on high technology, especially AI, once again showcasing a theme which we've been following closely on China Update for some time, that there are two Chinas when it comes to the economy. One China, which sees pockets of economic and technological dynamism with world-leading companies, and another China, the broader economy, the general economy where most live, which is going through an incredibly painful structural slowdown. Now, next up, we have another big development to cover, but just quickly, if you're getting some value from today's episode of China Update, it's a huge help if you can hit the like button, and if you haven't already and you'd like to continue watching these sort of videos going forward, consider subscribing. This is also a tremendous help for an independent creator like myself. It's just me making these episodes every day, but liking, sharing, subscribing, and going the extra mile if you want to, and supporting the channel financially with Patreon and Buy Me a Coffee links below. This is all a huge help and helps me continue making these episodes without a corporate bias, without editors looking over the shoulder, just grounded in sober analysis so we can try to understand the best we can what is happening in this large, consequential, complex, and opaque system of China. For those who do support the channel, as always, my deepest thanks and appreciation. I couldn't do it without you. We now move to the second half of today's video. China may have taken its boldest step yet in decoupling from US semiconductor technology. UK-based Financial Times reports today that the Cyberspace Administration of China, CAC, told domestic firms to stop testing and cancel orders for Nvidia's RTX Pro 6000D, a chip designed to comply with US export controls. Nvidia had already signaled it was not expecting significant Chinese demand for its H20 processor, another weakened model meant to skirt restrictions. The story raises a fundamental question. Is Beijing banning Nvidia's AI chips altogether, or simply signaling that it has no use for hobbled versions when local alternatives exist? According to the Financial Times piece, regulators recently summoned top Chinese technology and semiconductor players, including Huawei, Cambricon, Alibaba, and Baidu, to compare their products against Nvidia's restricted China market chips. Officials reportedly concluded that domestic processors had reached a level, quote, comparable to or exceeding that of the Nvidia products allowed under export controls, end quote. If true, the logic is simple. Why spend precious money on foreign technology that Washington has already crippled when Chinese firms can deliver near equivalent performance? This perspective aligns with Xi Jinping's directive at the April Politburo study session on artificial intelligence, where Xi stressed that China must, quote, concentrate resources to overcome challenges in core technologies such as high-end chips and fundamental software, and build an independent, controllable AI foundational hardware and software system. End quote. In other words, self-reliance in AI hardware is a national priority. Nvidia's trimmed-down offerings hardly fit into that vision. Nvidia CEO Jensen Huang struck a resigned tone when asked about the report. Quote, we can only be in service of a market if the country wants us to be, end quote, Huang told reporters in London yesterday, adding, quote, we probably contributed more to the China market than most countries have, and I'm disappointed with what I see. But they have larger agendas to work out between China and the United States, and I'm understanding of that, end quote. Huang further acknowledged that the company has guided analysts not to count on Chinese revenue, describing Nvidia's China business as, quote, a bit of a roller coaster, end quote. That blunt guidance goes to show just how much US export controls and now Beijing's apparent retaliation have clouded the company's prospects. Not everyone is convinced this is a permanent ban, however. Veteran China analyst Bill Bishop, in a post today, argues that there is still a chance Beijing is leveraging Nvidia as part of a broader negotiation with Washington. He points out that the Trump administration is under pressure from US firms and investors to loosen restrictions on the so-called B30, a modified version of Nvidia's Blackwell chip that is far more powerful than the H20. Any US-China trade deal could feature large Chinese purchase commitments, and a multi-billion-dollar Nvidia order might be one of the few sweeteners that appeals to the US president. If that is the case, Beijing's so-called ban is less about cutting ties and more about signaling. We don't want crippled products. either approve something better or will move on. At the same time, China is clearly ramping up its domestic ecosystem. Semiconductor Manufacturing International Corporation, SMIC, is reportedly testing advanced deep ultraviolet DUV lithography tools from a Shanghai startup, which could expand capacity for AI processors without relying on Western equipment. Local chip makers are also benefiting from speculation of massive orders. Chinese financial media outlet Caixin reported that ByteDance pre-ordered 200,000 chips from Cambricon, though Alibaba Cloud denied rumors that it ordered 150,000. Analysts caution that Cambricon faces bottlenecks and low yields, but the market potential is enormous. Sealand Securities estimates that a full Nvidia exit could open a market worth over $100 billion for Chinese firms. Meanwhile, China's internet giants are pouring capital into AI infrastructure too. Bloomberg Intelligence, in a report published today, projects that Alibaba, Tencent, Baidu, and JD.com will spend more than $32 billion on AI in 2025, up from under $13 billion in 2023. Alibaba alone plans to invest 380 billion yuan, $53 billion in cloud and AI systems over the next 3 years. For years, US executives argued that allowing Nvidia to sell advanced chips to China would keep Beijing addicted to American technology. Beijing's actions show how fragile that logic is. Bishop argued today that history demonstrates that when China identifies a sector as strategic, it prioritizes domestic capability, even if that means short-term pain. For Nvidia, the stakes are binary. If this is a negotiating tactic, the company could yet regain access to a lucrative market. But if Beijing truly closes the door, the China fantasy will finally be over. As Huang acknowledged, Nvidia's fate lies not in Santa Clara, but rather in the opaque maneuverings between Washington and Beijing. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a good Thursday, and unless something big happens, we will take tomorrow off. So I will either see you tomorrow or, more likely, on Saturday.